Homeowner equity totaled $29 trillion, or 70.5% of the total value. That's impressive. So we have record homeowner equity, and if prices plunge and equity decreases by 20%, we'll still be nowhere near where we were when the bottom fell out on housing in 2008. Of course, much of what happened in 2008 had to do with mortgages, and despite the rate on a 30-year mortgage firmly above 6%, a majority of homeowners are sitting pretty on this front as well. Right now, 85% of mortgages have an interest rate less than or equal to 5%. And as the chart shows, 65% are less than or equal to 4%, while nearly a quarter of mortgages have an interest rate less than or equal to 3%. If you're locked into such a great rate with so much equity, you might be reluctant to sell. Some would say you might even be stupid to sell, particularly if you'd have to pay significantly more for your next home alongside a 6% plus interest rate. Indeed, new for sale listings were down 13% year over year as of last week. So think about it this way. If you're too poor to own, but rich enough to rent, you're contributing to a super robust overall housing market. You're not doing anything for affordability, which remains just awful, but you're driving up rents and, in a way, helping us avoid an outright real estate crash. Because you know some renters who aspire to be homeowners will step off of the sidelines sooner rather than later. As prices come down, they'll bite the bullet on that high mortgage rate, waiting for the day interest rates come down so they can refinance. The bottom line is this: despite the flashy headlines and words like bubble and crash being tossed around, the only thing about the present housing market that isn't healthy is affordability. Yes, we're seeing homeowners take on an increasing amount of home equity debt. However, they're paying it back. And even if home prices fall sharply, we're not going to see large swaths of mortgages go underwater like we did starting in 2008.